If you own a business and you're paying your state income tax out of your personal bank account, you're probably leaving thousands or even tens of thousands of dollars of deductions on the table. And I'm not exaggerating. We find business owners all the time who are leaving multi-six-figure tax savings on the table purely because they're not aware of a simple strategy. Just last year, we had a business owner with $5 million of profit. They were costing themselves $150,000 a year in excess tax because of how they were choosing to pay their state income tax. That's $1.5 million over 10 years that they have been overpaying in taxes because they didn't do this one thing. So in this video, I'm going to explain to you why that's happening, what you can do about it, and a really neat case study that breaks it down. So let's start with the basics. If you own an S-Corp or a partnership, you are considered a pass-through entity. And so there's literally a thing called the pass-through entity tax, PTET, that you, as a pass-through owner, need to be aware of, where it actually allows us to write off your state income taxes federally through the business. And that's all made possible by something called the SALT Parity Act. You've probably never heard about it. We have found that many CPAs, for whatever reason, haven't taken the time to educate their clients on how to execute this really, really simple and highly effective strategy. Let me show you for a second inside of a tax return how and where I see this gap happening, so you can actually go check your own tax return to see if you're potentially missing out on this. So I've pulled up what's called a Schedule A. And a Schedule A is just a couple pages into your personal tax return. It's where all your deductions, if you're itemizing, which you would be in this case, are laid out for you. So I'm looking for this section. This is called the SALT, the state and local tax. And I'm looking for two things. I'm looking for how much did they pay, 60 grand, how much did they get capped out at, and so they only got to take a $40,000 write-off even though they paid 60. That is a $20,000 gap, and simple math, that's about 8 grand a year they're missing in tax savings. Now, this $40,000 number is new. This came out in last year's big beautiful bill where it used to be a $10,000 cap, which is crazy. Now it's at least $40,000. But there's a catch. Most of our clients make too much to participate in the $40,000 budget, and they're actually capped out and are forced back down to the $10,000. So as you can see, that would be pretty easy to surpass for most high-income business owners. Now, let's go into just a really simple case study that shows the difference between paying your state income tax out of your personal bank account and electing this PTET, which creates a beautiful write-off. Now, before I get started on this, I do want to emphasize something really important. This is just a simple example. This is to teach you and educate you. Everyone's situation is different. All right, so we have $1 million of profit with a 10% state income tax, and because of their income, they get capped at $10,000. So in scenario one, made $1 million, wrote off 10 grand. So my net take home is $544,000. By just simply taking the PTET election, I got to write off $100,000. Therefore, I'm taking home $567,000. In simple numbers, that is 33 grand a year. That's over $300,000 over the next 10 years. That's massive. And it's such a simple thing to execute. But it does take precision, and your CPA needs to be the one that brings this to life. Now, you might be asking, why doesn't everyone do this? Well, you gotta be an S-Corp or a partnership. You gotta be a pass-through entity. You have to have a state that has a state income tax. We find that a lot of people don't take this. We're seeing this now where a lot of people don't take this because they think they have a $40,000 budget, not realizing that they're probably over the income limit. And what they also forget is that their W-2, as an S-Corp owner, their spouse's W-2, rental income, investment income, those all contribute to state income tax at the personal level, which is likely going to eat that budget all the way up, $10,000 or $40,000. So let's go into an actual case study with a real client. This kind of builds off of my last video, which you can take a look at, which is 2 really simple strategies executed. It's going to save them a ton of money in taxes. Now, I'm going to preface before I pull this up. This has been tweaked for confidentiality. This is very specific to their situation. You need a personalized scenario analysis done for you, and this is just to teach you about what's possible. So we have a business owner in New York who, as a household, made $1 million. $700,000 was her business, and $300,000 was his W-2. Because he had a $300,000 W-2, he has ate up the whole $10,000 budget. So she has no SALT benefit left. So we executed 2 simple strategies. Let me give you scenario A, the before, first, and I'll walk you through scenario B. First, she had a really high W-2, $400,000 a year, which led to a $300,000 remaining pass-through. That $400,000 is pretty high. That's really capping what she can take on QBI. She got no state and local tax deduction. So she was walking home with $400,000 a year. On the other hand, we have a scenario we've talked to the CPA. We've got their blessing that it's still reasonable that she would be making a W-2 of $200,000 a year, which unlocks 2 major things. One is we now have a massive deduction for the PTET. We also have a much bigger QBI deduction. And those 2 things alone brings her home almost $433,000, which is a $31,000 a year tax savings. Again, that's $300,000+ over the next 10 years. To do 2 things, very simple, can take minutes to execute. You just need a personalized scenario analysis done for you by your CPA, and ideally with your wealth advisor involved. Now, there's a couple common mistakes I want to point out. You can't just start writing this off at the business level and still be paying it from your personal account. You also have to be documenting this appropriately, and again, executing this outside of your CPA is nuts. Now, you might be asking, why does this get missed? How does that happen? Well, often we find that most people don't have a tax planning process. A tax planning process would catch things like this. What they have is a tax preparation, a tax prep process. And then they usually also have an advisor who won't talk tax, won't talk business. They say just go talk to your CPA. So if you just bring to life a tax planning process with an advisor who's willing to talk business and tax with you, you can unlock a lot of amazing things. So here's the bottom line. If you're paying your state income tax personally and you own a pass-through entity, you're probably leaving a lot of money on the table. And the best part is we have a completely IRS-approved workaround. Key is get with your CPA, get it done right. And if you really enjoyed this and want to learn more business owner strategies in the future, subscribe.